Meet Mark. After starting his new job at the office, he's ready to start investing. He has explored a few different investing options, including stocks, gold, and real estate. However, after Googling around and watching every video about investing he could find, Mark is overwhelmed by all the information. Mark can't decide whether gold or stocks are the better place to invest his money. It's been a week, and he has still not decided where he would like to invest. He doesn't realize that he's losing money by delaying his decision as inflation rises and his cash loses value. So to help out, we're going to take a look at gold and stocks and the pros and cons of each type of investment. So what are stocks? At its simplest, stocks represent ownership in a company. So if you own one share of a company out of a total of 100 shares, you own a 1% stake in that company. Stocks are known for making certain investors very rich, such as Warren Buffett and John Bogle. They're also known for high returns when the economy is doing good. Gold, on the other hand, is known as a precious metal and measured in troy ounces. It has been used since eternity for trade and is considered to be a safe store of value. Currently, gold's role in investing is primarily to protect against inflation. So, if the economy is facing a downturn, many investors flee crashing stocks and move their money towards gold for safety. Now that Mark understands the basic differences between gold and stocks, let's look at some details. Difference number 1: paper versus physical. Gold is known as a physical asset in the world of investment. This means you can buy it and hold it physically in the form of gold coins, gold bars, bricks, and even gold jewelry. This trait is one of the most incredible benefits gold has over stocks, as stocks are not physical assets you can physically touch or keep in your home. Gold can, of course, be stolen, given its physical nature, so I wouldn't leave your gold bars sitting out in front of your garage. Still, as a physical commodity, gold does have an intrinsic value, and its supply cannot easily be manipulated. Gold does seem to retain its value better than stocks, and is largely safe from devaluation and inflation. Difference number 2: higher returns. Mark turned towards investing with only one objective in his mind. He wants to multiply his money and generate extra income. Let's crunch some numbers to see which asset offers higher returns. If we talk about the past 30 years, stocks have outperformed gold, with gold increasing by around 325%, and the Dow Jones Industrial Average increasing by 990%. However, suppose we adjust the time horizon to 15 or 10 years. In that case, we see that gold outperforms stocks, with a rise of 330% in gold compared to 153% in the Dow Jones Industrial Average. As Mark is more interested in long-term gains, he personally feels like he should invest in stocks. That way, he can save a lot when he retires and travel to many more locations than he intended. Apart from capital gains, Mark is also interested in earning cash back from his investment. He is happy to hear that many stocks pay dividends monthly, which he can use to pay back his debt, buy himself a present, or reinvest in stocks to earn an even higher return. Gold, on the other hand, does not pay you a dividend, meaning you cannot generate income from it like you can with stocks. However, gold does go up in price over time, so if you want to generate income, you would have to sell some of your gold. Difference number 3: better at hedging. Hedging is another name for protecting yourself from risk. Gold is dubbed a safe haven for investors, as it doesn't lose its value in recessions and economic downturns. Let's look at the recent slowdown in 2020 and the recession in 2008 and 2009. It is clear that gold retained its value and even increased, while all major stock indices, including S&P 500 index and Dow Jones Industrial Average, crashed and lost investors billions. Stocks are also generally considered risky, and many people argue that their value is determined through speculation, not anything real. Political instability, the economic environment, and the company's financial health all play a role in deciding which direction the stocks will take. However, this risk is short-term, and many stock indices give high and stable returns in the long term. Mark is convinced that stocks are a better option despite the risk involved. However, his friend Lucas is still not satisfied. He argues that gold is his go-to asset, as he is sure of its return. He would rather earn less than take a high risk with stocks and end up losing his money. He is also of the opinion that gold will save him from unpredictable market swings. Overall, stocks tend to lose value when the financial climate is hostile, while gold retains its value. So there is some wisdom in both approaches. Difference number 4: freedom to choose. The stock market is attractive for many, including Mark, because companies are creating and selling products and services. You can invest in any stock that you want to, based on your research about how well it will do in the future. You also have the choice to diversify your investment and explore new industries such as technology, pharmaceuticals, banks, and confectionery. With gold, this is simply not possible. Also, the stock market represents actual businesses with creative employees and problem solvers. They are constantly working to overcome the problems in the economy to increase their shares value. The stock market helps drive innovation as companies race to make new products to increase their share price. This helps investors like yourself get the best value for your dollar in the future through capital gains and dividends. Ultimately, this is more valuable to both investors and the world because companies are actively working to make products, provide services, and make their investors richer. Gold, on the other hand, outside of some limited industrial uses, is a non-productive asset. It generally just sits there and doesn't produce anything. Even farmland, in a way, is superior to gold when you look at it this way, because while farmland has a limited supply like gold, it can at least be used to produce food. Difference number 5. Fees and charges. One downside of the stock market is the brokerage fees and commission investors must pay on every transaction. It is a nuisance, especially for day traders who are doing several transactions each day. While the average commission fees range from 1 to 2%, they can become quite large as transactions increase. Unless, of course, you use a commission-free investing app like M1 Finance or Webull, which we have links for down in the description. On the other hand, if you want to invest in gold and save on your taxes, you'll need to open a qualified IRA account and pay a caretaker for your gold investment. Many people don't know this, but it's not legal for you to keep your IRA gold investments in your home. A one-time cost of roughly $150 is charged when you start an IRA account. You must also ensure that the gold you're purchasing, coins or bricks, complies with the IRA requirements. As a result, you must exercise caution when purchasing from a non-certified seller. This can be a lot of hassle. You are, of course, free to own any gold you like in your home, but in order for any gold to be part of your IRA, you will need to follow the rules I just explained to you. Also, when you buy gold, you need to pay a premium above the gold price, called the spot rate. So you buy it at the higher end and sell it at the lower end of the price spread. Just like in forex trading, gold can be sold relatively quickly. You can sell gold to your local jeweler, a pawn shop near your house, or online to trusted sellers. Stocks, on the other hand, can only be sold in the stock market. But these days, selling a stock is as easy as pressing a few buttons on your smartphone. So that isn't particularly difficult either. So both gold and stocks are bought and sold quite differently and have different fees and commissions. Difference number 6. Gold as a diversifying asset. Many people, after learning about the differences between gold and stocks, probably ask the question, why not invest in both? That way, if one investment fails, the other can protect you. Gold can be used as a diversifying asset. You can invest a percentage of your total investment in gold to ensure you don't lose all your money in the stock market. The problem with this strategy is that when the stock market posts impressive gains in an economic boom, you will lose out on potential gains because you have invested in gold. So let's say if your portfolio is made up of 30% gold and 70% stocks, you will lose out on 30% of your money gaining in value when the stock market outperforms gold. Still, Mark likes the sound of using gold as a buffer and is thinking of investing a small percentage of his savings in gold. This way, if there is a stock market crash, the value of his gold will actually increase during that time. That way, he can sell that gold after making a nice profit and buy stocks at cheap prices from other panicking investors. One thing for sure is that this method, holding his cash reserves in gold instead of leaving them sitting in his checking account, can open up an opportunity during recessions to sell gold at higher prices than one normally could. Gold stocks, a new category? When Mark asks Lisa, his Genius University friend, where he should buy gold from, he receives a very different response than what he's expecting. Why don't you purchase gold stocks rather than buying physical gold? That way, you won't need to store it physically, and you will still own gold. Mark likes the sound of gold stocks, and he wants to find out more about them. Gold stocks, also known as paper gold, are pretty similar to any other stocks you own or are planning to buy. You can invest in gold ETFs, which reflect gold prices, like GLD. However, you will not be investing in physical gold, instead in an ETF backed by gold. Another way of owning gold stocks is to invest in gold mining companies, like NEM and FNV. These mining companies also mimic the price of gold. You can buy ownership in the company by purchasing their stocks. The pros of investing in gold stocks are simple. You don't have to physically own gold, but you do have stocks that echo gold prices. You can easily buy and sell these stocks, which equals quick liquidity. You can also manage all your stocks from one place, which is much more efficient. The main issue with gold stocks is that they are, at the end of the day, still stocks. the price of these stocks are affected by management decisions and the general health of the stock market. For example, a gold mining company could mismanage their latest gold mine and lose investors' money, and issue more shares of their company to raise money to pay for the losses. These new stock shares would drive down the price of the company's stock, despite the fact that this company, in our example, is a gold company and should have a stock price similar to gold's price. For Mark, the decision is quite simple. He will create a portfolio made up of a majority of stocks. He will buy gold stocks that will mimic the gold market, yet he won't have to store gold himself. He is not in favor of buying physical gold, outside of a small collection of gold coins he has at home. He feels that he has diversified enough already in stocks. As the economy grows and companies innovate to stay in the competition, he thinks that's a better use of his money. Are you investing in stocks or gold? Or are you choosing a mix between the two, like Mark? If you want to get started investing the right way, consider using the investing app M1 Finance, which lets you buy and sell stocks and even gold stocks right from your smartphone. We have a link in the description to M1 Finance if you're interested in starting. If you use our link, you will get $30 just for starting investing. If you're still confused about all the different ways you can start investing, watch this video about trading versus investing.